Hello everyone, and welcome back to the Quant Lab. In Chapter 2, we built a massive quantitative toolkit. We used complex mathematics to measure the momentum, volatility, and exhaustion of the market. But remember, every single indicator is a derivative of price. To truly master quantitative execution, we must learn to read the market's primary language, raw price action, and spatial structure. Today, we initiate Chapter 3. We are going to strip away the indicators and look at the naked chart. We begin with the absolute foundation of market structure, support and resistance. In the Quant Lab, we do not view this as magical, invisible lines drawn arbitrarily on a screen. We define them mathematically as dense zones of concentrated liquidity and aggregate cost basis. Let's break down exactly why they exist. To understand why a falling asset suddenly bounces or a rising asset suddenly stalls, we must look at behavioral finance, specifically Kahneman and Tversky's prospect theory. Humans do not process financial gains and losses linearly. Um, as you can see on this curve, the psychological pain of an unrealized loss is statistically twice as acute as the pleasure of an equivalent gain. Imagine a large cohort of institutions accumulates a stock, creating an average cost basis zoom between price P1 and P2. If the stock price above P2, the buyers are in a state of unrealized profit because they have expended time holding the asset. They refuse to sell. If the price temporarily dips back into this zone, they will aggressively buy the discount. Active selling evaporates, buying surges, and a floor is formed. This is support. But what happens if the market crashes significantly below P1? The psychological regime violently shifts. The buyers are now holding underwater positions. They are experiencing acute loss aversion. They will endure the pain and desperately wait for the price to rebound. The exact second the price relaxes back up to their original cost-based zone, they will aggressively sell their shares simply to break even and escape the pain. This massive influx of break-even supply forms concrete selling. This is resistance. Because support and resistance are driven by the psychology of these trapped participants, this boundaries poses a fascinating mathematical property known as Principle of Polarity. When a definitive support floor is broken, it automatically flips its function and becomes a future resistance ceiling. Conversely, when resistance ceiling is decisively broken, it flips to become a future support floor. It is pure structural logic. If you break a floor, everyone who bought at the floor is now trapped at a loss, and they will sell to break even on the next bounce. While human psychology explains retail behavior, It does not explain why a stock can plummet, hit an exact price to the penny, and execute a V-shaped reversal. This extreme precision is not human. It is the footprint of algorithmic execution. Retail investors make up roughly 19% of market volume. The other 81% is driven by institutional and systematic execution, moving trillions of dollars. These algorithms do not feel fear or greed. They are programmed to hunt for liquidity. They mathematically identify historical price nodes where liquidity is thickest, and they cluster massive block orders at these exact coordinates. The convergence of human psychology and algorithmic precision is what solidifies support and resistance into highly tradable structures. Understanding the mechanics is only the first step. The true quantitative edge lies in exploiting these boundaries to create mathematical asymmetry. Every symmetric trade is governed by the gain-loss ratio. Your projected target gain divided by your maximum defined risk. Many introductory textbooks claim you must strictly demand a ratio of 2.0 or higher. This is a retail myth. In quantitative mean reversion system with win rates exceeding 50%, a ratio strictly greater than 1 is the minimum requirement for positive expectancy. Because we define our structure as zones rather than single lines, we can calculate different expectance based on our risk tolerance. Let's look at this figure and say we execute a trade at P entry with an overhead resistance zone from R1 to R2 and a support floor from S1 down to S2. The conservative ratio is that you calculate your target using the absolute bottom of the resistance ceiling R1, but calculate your risk using the absolute bottom of the support floor S2. If this worst case scenario ratio is still greater than 1, the trade is exceptionally robust. Then the aggressive ratio is that your target, the absolute top of the resistance ceiling R2, and assuming you can perfectly execute a tight stop loss the moment the upper support boundary S1 is touched. In other words, we use R1, R2, and S1. And the last one is the safe hybrid ratio, which is that your target the full breakout R2, but give the asset deep room to breathe by placing your stop safely below the absolute floor S2 to avoid algorithmic stop hunting. By defining zones, you eliminate emotional guesswork and execute purely on mathematical expectancy. In our next section, we will break down exactly how these dense zones form over time. See you in the quant lab.